Hey everyone, my name is Keshav, and welcome to the Buckner Project's series on financial literacy videos. Today, we're going to be talking a little bit about credit. First off, what does that mean? When someone extends you credit, it simply means that you owe them money, with an agreement to pay the amount owed in the future. Most of us are familiar with the concept of borrowing money. You want to pay for something, but you don't currently have the money to be able to afford it. So you ask someone to let you borrow the money. They provide you with the money so that you can afford it, with an agreement to pay it back in the future. Borrowing lets people buy things that they wouldn't otherwise be able to afford. And it provides them with the money that they need upfront and offers them the option to pay it back over time. This applies to things like credit cards, student loans, auto loans, or home loans, which are also called mortgages. If you use your credit card to make a purchase, you're only buying time, and you'll eventually need to pay that money back to the credit card company. Not all credit is bad, and if you're smart, you can make credit cards work for you in different ways. We'll be talking a little bit more about credit cards and loans next. When you borrow money from a bank, you could say that the bank is giving you credit. One type of credit is a loan, like a loan for a car or for a house. Can y'all remember what a loan for a house can also be called? That's right, it's a mortgage. Another type of credit is in the form of credit cards. I'm sure you've seen your mom or dad use a credit card, or someone on TV use a credit card in ads. So you probably have some level of familiarity with what a credit card is. When you have a credit card, it means the bank is lending you money. The bank or the credit card company usually puts a limit on how much you can spend or charge on your card, which is called a credit limit. When you use a credit card for a purchase, it's very convenient. You don't have to pay cash at the time of the purchase, but you're taking a responsibility to be able to pay that money back at the end of the month. And you can pay all of it off at that time whenever your credit card company sends you the monthly bill. Or you can pay a smaller amount every month called a minimum payments amount, which we will talk about in the next slide. Unlike savings accounts where you can earn interest, with credit, you may have to pay interest. And with credit cards, the interest rate can be very high. Credit cards are good when you're buying something you know you can pay back at the end of the month, or for emergencies. You should think of credit cards as a convenience and a safe way to make a purchase. But it is important that you try to pay that money back at the end of the month, when your credit card bill is due. Let's talk a little bit more about what minimum payments are. When you charge your purchases to a credit card, at the end of each month, you'll receive a credit card statement with the total credit that you have to owe, but you'll also get what's called a minimum payment, which is the minimum amount you have to pay at the end of each month to keep your credit card in good standing. But if you only pay the minimum amount that's due, and not the total amount of money on the credit card bill, it's not a good thing, because the slower you pay the money back, the more interest you'll have to pay every month on every cent that you haven't repaid. So at the end of each month, you want to pay the amount on your credit card bill off fully. Now, let's take a look at loans. Loans can help you achieve major life goals you couldn't otherwise afford, like attending college or buying a home. With loans, you borrow all the money you need all at once, and you pay it back monthly. With loans, you also have to pay interest, but it's usually less than the interest that you pay off with a credit card. Plus, with a loan, Once you pay it off in full, you're done. No more loan. There are different kinds of loans that you can apply for. Some examples include personal loans, auto loans, student loans, home loans, and I'm sure that y'all know the other name for home loans by now. Mortgages. But there are also a variety of other loans that you could go for. One example that you might see on the TV is a motorcycle loan. Loans are great if you're really into buying expensive things like cars, homes, or a college education. If you've been responsible with your money and bank accounts, banks will be more likely to give you a loan. They'll see that you've been responsible with your money, and they'll have the confidence that you'll pay it back. In conclusion, credit is a great tool, especially for buying expensive things. But you should use credit only for convenience, like using a credit card, or when you can pay it back. Otherwise, it can lead to a lot of problems. Of course, you might not really have the opportunity to do that if you're facing some financial duress, which means that you're having a little bit of a hard time financially, in which case you might need to use credit to buy basic needs such as food and clothes. But that's sort of a last case scenario. Will you be ready for credit and loans when you need them? If you stick with your budget and later manage your savings and checking accounts, you'll have what it takes to get credit and keep it. Remember, credit is a privilege, and you should only use it if your budget shows you can pay the money back. As always, thanks for tuning in to the Buckner Project series on financial literacy videos. I'm Keshav, and I hope you learned something. Stay learning.